but obviously it will take time to explain it. And I don't want to, we've already gone on for ages here, and but I also am pointing it out because it's important. I like to let people know that there is a slight variation because of this problem around the mode in the market profile can sometimes be at the same price, but look at the difference. As I said, you've got to be not obsessive about slight variation. So look, they're virtually about the same. Sometimes, as you can see it here, I just noticed it, they can vary, a little bit, but I can take anyone through it, exactly how it's calculated, why it is, etc., etc. And maybe in the future, I might add a section in, but honestly, you can Google it. It's explained really well in the books that I told you about. Where's the value add? I'm not going to be able to add value to you. You can find it on Google. It will take, it's a bit involved. That's what it is. And I don't want to start going off on tangents and confusing people when I've just spent the last 7 hours doing theory or whatever. So look, there is a slight difference, but honestly, it's not important for trading. For me, it doesn't make a difference in my trading, but yeah, technically, if you want to know, reach out to me, drop me a message, and I'm happy to either add it in or explain it to you exactly to the tick why these value areas are slightly different. I mean, it's obvious that it would be, right? Because obviously when you're calculating your statistical distribution here, it's using individual outcomes, right? So it's market orders, individual. As you know, these are not market orders, right? They're not individual transactions. It's obviously data points using time at price. So obviously the way it calculates distribution is slightly different to try and be as closely aligned to how the actual normal distribution. But you can see it's a bit involved, so I don't want to lose people basically. So again, sorry to repeat the point, but yeah, if you're really interested, let me know. But otherwise, I'm not really going to cover these because we've already covered them. And with the volume, it's called the VPOC, which if you said to someone in any professional environment VPOC, they'll know straight away, volume point of control from a volume profile. So it's exactly the same thing as the point of control that I already discussed in the distribution section. But just to repeat, it's basically the area where the most transactions took place. Value area we've discussed to death. I'm not going to discuss it again. I just wanted to show you that. Can you see? It's very, very similar. That's the value area high. That's the value area high on a volume profile. So very, very similar. Just wanted to show you that they're pretty much one and the same. Obviously, because of this issue where it's not market data, it is obviously going to be more accurate on a volume profile, but we don't want 100% accuracy, we just want approximation, so it's fine. Balance and imbalance, I'm not going to cover it because, we've covered it, probably more than some of the whole entire Forex courses are. We've been speaking about balance and imbalance, so we've already covered it. So what I'm going to do is, I'm just very quickly going to fly through single prints, excess, poor highs and lows, initial balance, etc. But just doing it we don't need to look at volume profile for these because these are quite specific things to market profile. So give me a second. I'm going to just get rid of the volume profile. Okay, so I got rid of the volume profile, and actually I'm just looking at it. You won't be able to see it, but if you can make a note of it if you want, but the bullet points, it's easier because then I can have the whole sort of screen to work with, but we'll just go through them one by one. So the first one is single prints. So single print, what it is, guys, I'm going to go through these really quickly. Obviously, if you want more detail, it's all out there on Google. You can read the books and whatever. I don't see, as I said, 90% of what's there, I don't use it in the way that it's used by market profile guys. But this is why I said, prove it to yourself. Don't just take my word for it. Look, I mean, I've got years of observing this, and I've found that you just got to take a lot of this stuff with a pinch of salt, because otherwise what happens is you'll notice, and that's why I wanted you to read the market profile books, is they'll say, oh, when this excess happens and when single prints happen and when poor highs and lows happen, this has to happen. And I'm like, well, actually, I've been watching this a million times and it hasn't happened. Do you see what I mean? I proved it to myself. But I don't want, just because I tell you, I don't want you to do that. I want you to prove it to yourself as well, along with the million other things that obviously I'm showing you. But we're going to, obviously, just for sake of completion, I do want to explain very briefly what they are. So single prints is the first one. Guys, very simple, it's just that. It's where in a region, say you've got a profile, obviously that's high to low, not necessarily the value area. Anywhere in here where you've got single prints. You see in volume profile, obviously that's meaningless. It's a market profile term. Can you see it there? E period between that price and that price, say around 62, this is crude oil from a few months ago, by the way, 62.25 to 62.35. It only printed the E period, single prints. Okay, here, this price, 63.10 to 63. By the way, I absolutely love market profile, if it isn't obvious. I love this thing. But yeah, it's printed single prints here. Very versatile. And I love volume profile as well, but obviously each has its strengths and weaknesses. Combining them together when we get very advanced is very powerful. But anyway, enough of that. So yeah, single prints, you can see them there. Can you see in that F period? We can even break this out if we want. You can see the market just zipped through. There was no overlap. That's what single prints are. What does it mean? I mean, this is the thing. You can read the books, it'll tell you this, it'll tell you that. I'm just going to tell you from my own experience. What it means is that generally, if you've got a period that will balance over this one, so for example, here clearly the market, opened, it balanced. I'm talking about this area here. Then it came down, we went imbalance, and then we balanced here. What you'll find from my experience, and again, observe this for yourself, do not take my word for it, is let's say, I mean, obviously here the market gapped down, but let's say it didn't. Let's say the A period opened here, and then you built obviously a bunch of A's, you built a bunch of A's, whatever, and then B's and B's and B's and C, C, C. I'm just making all this up, and D's. So this was kind of your profile, and you started approaching this area, and then E, again, I'm making this up, guys, F. As it comes into this area, what you notice is this will just zip through. Typically, that's what happens. So in market terms, what will happen is the market will open, and it will start to build some balance, and then it will just zip through, and then, do you see? Why is that? Think about it. What's happened in the past? Imbalance. What is a single print? It's just imbalance, isn't it? Balance, imbalance, balance. You can see it here, balance. Came down, imbalance, balance. That's all the market's doing all day long. Imbalance, balance, imbalance. So here, clearly if there was no interest, what's going to happen? It's going to be the same. Generally, I'm not saying every single time. This is the trouble. When you read these books and whatever, I want you to see for yourself, they can be very dogmatic. Me, I don't know. It depends on all the other factors. Where's the VWAP? Where's value on a different perspective? Where's this? Where's that? Is there order flow, supportive? 10 things come together? Yeah, it probably is going to push through. Do you see what I mean? Whereas the books will say, nope, single print's got to push through. This is my point. When you start to really develop a holistic understanding of markets, you can really start to, know whether this stuff is going to be a supportive factor or not, etc., etc. So that's single prints. Hopefully, I think I even covered that probably better than the book. But go and read the book if you want. Like I said, I'll do it because it is going to go into a lot of detail about this stuff. Personally, I think that's all you need to know. But again, figure that out for yourself. Then the excess, essentially, is just they're tails. I haven't written them down on bullet points, but they're basically buying and selling tails. So you can see it here. I'm sorry if I end up covering any of this stuff, but you can see loads of tails here. Can you see that tail there? That's a tail there. That's a tail. That's a tail. So it's single prints, but at the edges of profile. they're just tails basically. Excess, basically the clue's in the word, isn't it? It's pretty obvious. It means that the market got excessive in that period. So a period there, you can see what happened. It did gap up, but basically the market, this is a better example because it happened after the market open. Can you see that? The C period, excessive. Market got overextended, right? Simple as that, really. And then it came back down. And what it is I'll tell you why it's quite useful. But again, you can read the book because the book will give you loads of strategies on this. I don't use any of that stuff. To me, personally, I just like profile for the merges and things. But the thing is, I did used to get obsessive, and this is the point. When I read the books and obviously stuff I was taught in institutions, and you know what people told me, and they would tell me about excess and this and that, and I still hear about it all the time, and it does make me laugh because I did used to get quite obsessive about it, and it was through experience I realized that, do you know what? At the end of the day, there's another 9 factors that will determine whether the excess is useful or not. As a standalone, basically, why is excess useful? Because don't forget, you could be, so let's split this out. Actually, if we split out the D period, think about it. You could be 1.5 hours into the day, right? And I used to do this. So I used to watch market profile. So, you know, as I said, it's 9 to 9:30, 9:30 to 10, 10 to 10:30, right? And you can see, it even told you where it closed. Come 10:30, I can see, we've produced excess, and therefore we're probably going to have to unwind the excess. So the D period is probably going to pull back. Okay, so it can be useful, but the problem was I used to get too stuck in that without looking at the other things that to me are more important, which we'll obviously come onto, you know, like VWAP over different time periods and some other stuff. Order flow obviously is important as well, cumulative delta, which I look at. So you can see why, in theory, on its own, it is quite useful, and people do like to look at excess. Okay, so hopefully that was useful for you. And then we look at poor highs and poor lows. So this is really interesting, okay? Poor highs and poor lows, again, this is why I want you to read the book. You're not going to see, the way I explain to you poor highs and poor lows, you'll never see it explained. I've noticed this, there's a real lack of understanding over what's actually happening here. So there are, poor highs and poor lows do get taken out, and essentially, can you see, it's called an unfinished auction. Do you see how generally 90% of the time you get tails, you get excess, right? Why is that? Because the market will start, it will excess, and then it will come back and it will balance. Excess, overextend itself, come back and balance. Extend, come back, balance. Extend, come back, balance. Extend, come back, balance. Open the day up there, A period, come back in and balanced. And by the way, I do apologize if I didn't make that clear, that you can see the open and close is marked there, right? That blue, that's where it opened, and that's the close. Okay, so apologize if I didn't say that before, but that's why I'm saying it. Opened there, excess, and came back. Then he got excess, came back. But can you see on this day, we didn't get any excess. H, I, K period, they were all at the lows, and those 99% of the time, they will get taken out. But in the book, and even in institutions to some extent, the way I hear them being explained is wrong, basically. Let me see if I might not be able to find, there you can see one there as well. Poor low, which got taken out later on. But yeah, so those are pretty solid ones that I was. I just want to see if there's any others. I don't think there are. So what it is it's called an unfinished auction. What basically the way I've heard it explained is that sellers weren't able to do business, finish their business. So in the way you get excess here, sellers were able to do their business, albeit they got overextended, but they'd done their business and then they were done, kind of thing. Or the market completed this selling auction. Over here, there was no excess to complete the auction. What actually happened is the selling inventory basically needed to rebalance. So what happened is, you can see there were 3 periods. So if you think of it in chart terms, because they're quite close together, it's not, you can't actually see that. But if you think of it on a 5 or 10 minute chart or whatever, if you think about what actually happened here, market was balanced for a while, then it came down, then it came up, H period, I period, came down, right, I period, then came up for a couple of periods again, then it came down. Okay, now markets don't usually do this. They will usually, as you know, they'll take stops out or whatever. They'll have this excess type of action where it'll more be like boom, and then that's it, you're done, and then you move higher, don't you, and whatever. There'll be excess where weak hands got flushed out or whatever the reasons are, it doesn't matter. So the way I've heard it explained is that what's happening is that people have come down, they weren't able to produce excess, they came down again, they weren't able to finish the selling. The sellers selling inventory needed to rebalance, weak hands needed to be taken out before a renewed push, and the theory is therefore it will get taken out. And by observation, I'll be honest with you, it does get taken out. But I don't understand this whole weak hands thing, and I mean, I get weak hands, but I don't get it in the context of this, the way it's explained. Actually, what's happening, and I know because obviously, I worked on as you know, when I was on the Sterling desk, I worked in a interbank environment, and actually, I'll tell you what's happening. And even guys in proprietary trading firms don't know this, and obviously I was fortunate, like I said, to have worked on a desk where I saw a lot of this flow coming in these areas. What's actually happening is people that are getting long here, they're placing stops. So if you think about it like a cone shape, there's some stops being placed here. Okay, then it flattens out for a bit. Then you see here, then more people get long, more stops. Now don't forget there's stops here being combined with new stops here. So you can see the stops are growing. By the time you get to this stage, you've got the stops of these longs, and these longs. That is actually what's happening. You won't find this anywhere, by the way. Nowhere have I seen this. It's not some secret. It don't really make a difference to me. Obviously, I've said, I'd rather you be discreet about stuff, but whatever. No one's going to make millions out of this, but point is, at least you should know what's happening, rather than half the nonsense I hear about unfinished auctions and whatever. It's all nonsense. Basically, this is what's happening. Stops, and it makes sense, right? Long, stop behind the low, long stop behind the low, so it builds up, long stop behind the low. So you just get stops building, and the market knows this, and it needs to clear out the inventory before moving higher or can continue on its merry way. But typically, I do pay attention to this just because if you're trying to get long in this area, you probably want to wait for these stops to just be taken out, especially if they're built up, because 99% of the time the market is going to do this. And we're going a little bit off topic here, but it's important because books ain't going to tell you this stuff. I'm telling you this from real trading experience. Is that the problem, however, with this and being obsessed with it is I've also noticed is if you get an amazing setup for, you've got some amazing contextual level here, order flow is strong, you're getting value being built here, and you've got some great achievable levels up here, and you've got this poor low down here. Guys, I'm going to take the trade, right? Whereas people who become obsessed with this, they're going to say, nah, they're going to miss out, okay? And this is why I say, don't just take my word for it. Watch out for these things, and you will as you develop as a trader. So, actually, I think I've explained poor highs and lows better than the book, but again, and I don't mean that in an arrogant way. I'm obviously being quite serious about that. Is obviously I feel I've given you stuff you're not going to get out of a book. Okay, and then the last thing is there's letters versus blocks, but let me come back to that in a second. There's initial balance. which I'm not really going to cover in any detail here. All it is, can you see this A period is 30 minutes? This B period is the next 30 minutes. A lot of people, I don't look at it, a lot of people, and you can read on Google about this, I'm not going to cover it in depth because I don't even look at it, but they like to look at this as the initial balance period. Some people use, I'm going to be honest with you, I do like to use 5 minutes sometimes, but I don't use the initial balance. I like to look at the market in the first 5 minutes. And the reason people do that, and the reason that's not the initial balance, because the initial balance is 1 hour generally. I think that's too long a period. The reason people do that is because, like I told you, it's the pit open and people get their business done. So what you will notice is, the theory is that it gives you very good, let me find a good example. Do you see why I don't even like it? You have to end up cherry picking, and I don't really find it that great, but the theory behind it, I'll tell you anyway. The initial balance period is, and I do know a lot of people that look at it. Like I said, personally, I don't. A and B, that's 1 hour, right? We know A is half an hour, B is half an hour. So what people do is they take these as contextual levels. So the high and the low, essentially, they call it the initial balance high, okay, and the initial balance low. If you say this to anyone in a professional firm, they're going to know what you're talking about straight away. And essentially, you're either looking for rejection at the initial balance high, or obviously here you see the market went up, built some value, and then went imbalanced. Okay, so like I said, I don't necessarily use it, but that for completion, I'll obviously let you know. But you can read lots about that on the net. What it is basically the reason why it's popular is obviously pit volume is taking place, like I said, in that first period, so a lot of people are getting orders done and business is being done for the day. So the theory is direction is being set in the first hour. So, something that I don't particularly use. I use a shorter period, but we can speak about that later. But that's the initial balance. And then finally, guys, I'm going to be honest with you. I actually I don't like using the letters, okay? I actually prefer using blocks. So there is this option. I mean, it's up to you what you use. You can use letters or you can use blocks, okay? Now, unfortunately, my chart's gone a bit haywire, but okay, sorry about that. Yeah, you can see the chart just went a bit, decided to get into its mind of its own there for a second. But actually, it was good that he did that, because what I decided to do, and it's much better, is I thought I'd actually show you the letters and the blocks. So there you can see that poor low that we discussed. There's the initial balance, the A period, B period. Do you remember? And we said that was the initial balance, low and high, and then it just went in balance. So you can see the exact same thing here. And there, can you see the poor low with the 3 dots? What it is, I mean, it's up to you. I used to be quite obsessed with market profile. And like I said, I very quickly stopped any behaviors where I started to notice myself becoming a little bit too rules-based and things. And I just got rid of the letters. I'll be honest with you, I don't really find the letters any use, because it was actually like people were saying, oh, did you see what happened in the A period? But the C period did this and D period. And no, I just stopped that at once. I was like, do you know what? Let me use it for what I originally wanted to use it for, which is to merge and to build nice balanced areas. So for me, that's it. But again, I want you to go on that journey. It's an incredibly useful journey. If you want to play around with it, it's a brilliant tool, and come to the conclusion yourself. Or you can do what I do, and I'm going to be, what am I going to do? Yeah, going forward, I'm not going to show any of these, because this isn't a market profile course at the end of the day. This is, combining many factors together, and really this is a dangerous thing for me to do if I was to start pointing excesses out and single prints and this and that. It's not going to do you any favors in my opinion. But I also do think, as I've said many times, that you should maybe try the letters for a bit and see if you reach the same conclusion as me. But yeah, I just want to make it clear that I'm not going to use these letters going forward, For those reasons are about 90% of it. But also, look, I can see 1, 2, 3, 4, maybe half there, a few profiles there. Here, look how many I can see. Loads. I can see so much more information. And I'm not bothered about these little tails and this, and it doesn't do it for me. From observation, obviously I proved it to myself, and I mentioned this at the start of this section where I talked about the book, and you can probably see why. Because I went through that process. And some people did warn me about it, and some people told me it was amazing. I said, you know what? Let me just figure it out for myself. Let me read what's out there, the literature, and let me go and observe it. And my observations told me that, nah, the other stuff I'm looking at is much more important than, becoming too obsessed about this. So I just stopped. And don't get me wrong, I find market profile incredibly useful, but for the purposes that I mentioned, which is obviously to look at balance areas. These little other nuances that I talked about, like all the single prints excess, poor highs and lows, and those kind of things. If they're there, I'm obviously aware of them, but they're very low down on my list of priorities. So that's it. And the only thing left to do is the shapes. So let's just very quickly talk about the shapes, and then we're going to end this section. Okay, so the first shape is fairly straightforward. It's just a D. So I'll show you obviously by pen, and then I'll try to see if I can find a good example. D shape is what? Just balance, right? You can see it there. I talked about the Gaussian, the bell-shaped distribution, the nice sort of volume, right? So balanced volume. So you can see it there, and then obviously there's a very bad drawing of value area, and then the central bit basically. So let me just do that again, because that was pretty atrocious. Yeah, so you got basically your D, isn't it? That's your D, and then that's obviously, in theory, your POC, right? Or VPOC, or whatever you want to call it, and then nice balanced area. So you can see that is a nice D shape. It just basically, what it in theory means is the day was balanced, and there's no clue as to what the direction is likely to be for the next day. The next one that is often talked about is P. Okay, it generally means short covering, so probably more useful if I draw it down further down here. So let's say the market, obviously is got short, and it just covers those shorts, and then it's likely to go up, isn't it? Because it's basically liquidating the short inventory very quickly. That's why you get a very quick move up in balance, and then the next day you tend to move higher. So this is a okay example of it. It's not the greatest. I mean, ideally you wanted it to open there, but you get the principle. P. Okay, so what it means is people got short, quickly liquidated, and then we balanced to then typically move higher. So that's, and I may have actually apologize. Let me just double check. No, I just missed my nose, didn't it? I'm sorry about this. I know, but I hate editing stuff out, and I don't want to necessarily. I just want to make sure you got that. So it looks like you did. In fact, that was. Sorry. Let me just move it out of the way for you. Unfortunately, I can't see myself. So yeah, just to make sure you got that, it's obviously this, isn't it? When the market's moved down, and essentially those shorts have done what? Quick liquidation. Obviously, if this wasn't a short, fast liquidation, you would have seen what? You'd have seen volume here, right? It would have been a different shape. But shorts got liquidated, we came up, we consolidated, and boom, you go up. That's the theory. Look, like I said, I don't use any of this stuff. I said it before. To me, I'm going to be honest with you, it's nonsense. because from observation, I don't see it happening that way. There's a ton of other factors that's going to determine if the market's going to obviously rally the next day. So I do sometimes laugh at these things that I read, and even that they teach. You'll see even professional firms teach these shapes and whatever. I think they're okay to, obviously it's good to know about them, but I don't actually think that they're trying to mislead you, but I do think that what they're trying to get you to do is use this as a foundation and observe and figure out for yourself, nah, that's not right, that's not right. You go through a process of elimination. So obviously, coming back to the point, obviously the opposite of the P is what? The B. So this is short liquidation, consolidation, go up. This is what? Long liquidation. Guys got long, had to liquidate for whatever reason, stopped, whatever, market changed its mind very quickly. Consolidation, and then boom. The other way, it's just the opposite. You can see it here, look, B shape. And this is actually a pretty okay example, I suppose, but again, it didn't open here, did it, and then go up. It's the best example I could find in terms of the shape, but you get the principle. In theory, what they're trying to say is the market's tried to get long and actually, boom, liquidated out everyone, consolidated for a couple of days, and then crash. So that's in theory what that's doing. And then the final one, again, you'll read about, it's quite funny in the book, you read about like 1,000 different variations. Read about them, you know, even just out of interest. And like I said, go through this, try to observe them. In my opinion, doesn't really tell you much because there's 1,000 other things going on. This is just, it's too much looking at it from a single lens. There's too many lenses out there for this to hold accurately every time. So, you know, if you want to use it by all means, but at least prove it to yourself, you know, through observation that you don't think it has any staying power. For me, it doesn't, so I don't use it. But like I said, I went through that process. B shape is okay, you know, it's like a double distribution day. So you can kind of see it here. In fact, this is quite a nice example of a B shape. There, can you see that B shape? It's just a double distribution day. So what it means is that the market had two balances. It was trending, is, you know, what it's saying. Even though I don't necessarily like that word. Can you see it was balancing here? Then we moved up and it balanced here. Do you see that? So what does that do? It causes a B to form. Okay, and the theory is, obviously you build some value, you go up. If you build value and you fail to go balance and fill in this lack of volume, the theory is you continue, continuation. That's the theory. Does it happen in practice? I don't know. The problem is, like I say, there's just too many factors driving the market for it to just be as simple as, oh, if we balance, we go up, we balance, and we fail to form, you know, the distribution, which would be what? To come back here and fill in this imbalanced area to obviously form a nice distribution. Then the theory is, well, you might as well, you're going to continue, but you know, you're going to get, there's just all sorts of stuff going on, is my point. I haven't really found it to be of any value to me. I did look at it when I first got into profile, on a chart anyway, and I heard about all this stuff. Obviously, like everyone, I thought, let me have a look at it. I didn't dismiss anything, but I can tell you right now, I certainly didn't throw money at it until I'd been 100% sure whether it worked, and to me it didn't. So that's it. But look, thanks for sticking through that. I know it ended up actually being a long session, but I'm really happy with the way it came out. I covered everything, a market profile, and what we're going to do next is we're very much now going to just give you a sneak preview. We're going to start combining and building contextual levels, and it's really exciting. So we're going to merge areas, and yeah, we're going to start looking at market opportunities around contextual levels. We're going to see, oh, imbalanced. If it comes back in, then we'll look at balance in this area, come back out, and so on and so forth. Obviously, I'll combine a lot of these, and you'll see the market does tend to go to the other side, and then we get imbalance opportunity. So it all looks like a bit of scribbling, but we're going to do this together now in the next section. So yeah, that's market profile. Hope that was useful to you, and we can now start to actually use it, because obviously you've got at least enough of an understanding of it for us to start looking at it on the chart. So don't forget, I'm going to look at it in blocks because I don't really find any use in those letters, but you're more than welcome to, I'll leave in the template, I'll probably put both on if you want the other one, or maybe I won't, and I'll just show you obviously the option of how to change it. All right guys, see you in the next section. Cheers.